Hello, good morning and good afternoon and good evening for those that are watching us from other parts of the world. Welcome to our first Distinguished Tax Policy Lecture. My name is Mehmet Tosun. I'm the Director of International Programs in the College of Business. I'm also a Professor of Economics and the Barbara Smith Campbell Distinguished Professor of Nevada Tax Policy. This lecture series is a new initiative under our new research lab that we are calling NB Global. That stands for the Nevada Global Business and Economics Lab. It is my pleasure to have Dr. Vito Tanzi as the distinguished speaker in our first tax policy lecture. I'm going to say a few things about Dr. Tanzi and then turn it over to him for his lecture, of course. Dr. Tanzi, an economist with specialization and international reputation in public finance, and also microeconomics, but particularly tax policy. After receiving his economics degrees, including a PhD from Harvard University, Dr. Tanzi worked at American University in Washington, D.C. for a number of years as a professor of economics. He was also a department chair for about 4 years during his tenure there. He then moved to the International Monetary Fund in 1975, first as the head of the tax policy division, which is within the Fiscal Affairs Department at the IMF. He later became the director of the Fiscal Affairs Department and served as director for almost 2 decades, from 1981 to 2000. Now, after he left the IMF, he served in the Italian government as the undersecretary in the Ministry of Economy and Finance. So this is the same level as a deputy minister. Dr. Tanzi was the president of the International Institute of Public Finance from 1990 to 1994. For those that don't know that association, it is one of the oldest public finance associations in the world. And he's later become an honorary president of the International Institute of Public Finance. Dr. Tanzi received honorary degrees from 5 different universities in Italy, Argentina, Belgium, and Portugal. He's done consultancy work for agencies such as the United Nations, the European Commission, the European Central Bank, the World Bank, the Organization of American States, among many others. Dr. Tanzi has made important contributions to both public finance and macroeconomics, and a number of subfields within those fields, including economics of corruption, tax evasion, money laundering, underground economy, the impact of inflation on tax systems, among many others. An economic effect that is referred to as the Tanzi effect, which is about the relationship between high inflation and tax collections in countries, was named after him. Dr. Tanzi published hundreds of articles in top economics journals, including the American Economic Review, the Journal of Political Economy, and Economic Journal, among many others. He authored more than 20 books in several languages too. His most recent book was entitled The Economics of Government Complexity and the Practice of Public Finance. Although he told me recently that he just sent another book to the Cambridge University Press. I mean, he's just a very productive writer. Of course, I knew of Dr. Tanzi and his work and publications for a long time. I cited his research, his papers in my PhD dissertation. And I actually was a visiting scholar at the IMF's research department in 2004, but I missed him by just like a few years. Later, I actually met him in person when we host the International Institute of Public Finance World Congress in Lake Tahoe in 2016, which was attended by close to 400 people from about like 40 different countries. I'm very pleased to have him again, but this time in a virtual setting. Dr. Tanzi's lecture is titled, Does the World Need a World Tax Organization? Dr. Tanzi, thank you for joining us today. As we discussed before, you have about 45 minutes to an hour. Your presentation will be followed by a Q&A session, which will run for about 15 minutes. We expect to end no later than 11:30 a.m. Pacific Standard Time or 2:30 p.m. Eastern Standard Time. I would appreciate if you write your questions to Dr. Tanzi in the Q&A tool at the bottom of your Zoom screen. Without further ado, I'm inviting Dr. Tanzi. Dr. Tanzi, so you have the mic.
Thank you very, very much. First of all, I want to say that it's a great honor for me and a great pleasure to give this lecture. I want to thank the University of Nevada and Professor Tosum for inviting me. It's the topic I'm going to talk about is a topic that started worrying me more than 30 years ago. I think I wrote the first paper on these issues in 1987 in an important book edited by Herbert Stein, who had been the chairman of the Council of Economic Advisors. And the book included paper by Stiglitz, by Larry Summers, and by others. And the book was called The Taxation in the 21st Century. And in that book, I began to recognize the impact that the globalization could have, or was at the start having, on tax system, and predicted that the problem would become more and more serious as time passed. So that essentially, I want to elaborate on this problem, and I want to add that I've become over many years I've become more and more convinced that there are some public goods which are no longer national public goods but global public goods, and this dealing with these global public goods really requires changes in institution, some major changes in institution. So I will come to this issue around the end of my talk. But first, I want to introduce the topic of why globalization is creating problems for tax systems, and why, without dealing with these problems, we are going to have more and more difficulties with the passing of time. I want to remind the audience, obviously they already know it, but remind them that the tax system changed dramatically over the past 70, 80 years. At the beginning, tax systems were created for local activities. Most of the activities were local. You produce a product for your neighbors, you sold the product in the neighboring market, and the taxes that could be used at that time were very particular. For example, in the US, much of the tax revenue in the 19th century came from import duties. There was a lot of controversy, but import duties were very important at the national level. At the state level, where taxes on excises were normally quite important. So these were the framework of tax rules that was created was related to this kind of local activity and these particular taxes. But as we move forward, we move from the 20s to the 30s to the 40s, then the situation starts changing. By the way, in the United States in 1913, introduced the income tax for the first time. And there was a big fight that went to the Supreme Court on whether the government had the right to impose taxes on income. And the income tax were created with very low rates. You had to essentially be a millionaire at that time to pay 5% or 6% marginal tax rate. And most people were excluded from it. The number of people who were taxpayer was very limited. And so these taxes, when the income tax came, but progressively the income tax over time, both in the US and in other countries, became more and more important. Another tax which today is a really very, very important tax, it competes with the income tax in terms of revenue, is the value-added tax, which interestingly enough, the US is the only major country that does not have it, But the value-added tax was introduced in France in 1956 by somebody called Maurice Lauré. And this tax became from France, was exported to the colonial countries of Africa, of France, then across the Atlantic and went to Uruguay and Brazil and Argentina and so forth. And now it's a world tax. Almost any country in the world has this tax. These two taxes, income tax and value-added tax, now are the worst source of tax system. They account for most of the revenue. If you exclude the revenue for these two taxes, we have a very little left. So this was the situation, the way the situation has changed. The problem is that the globalization came in the process. During these years when the tax system were transforming, were changing, the globalization started to have its effect. The world was very little globalized until after the Second World War. Then globalization started very timidly for a couple decades. But then in the 70s, we got this phenomenon started developing. And of course, economic thinking had something to do with this. The market fundamentalism and so forth was very important. So globalization began to bring major changes in relationship, and it brought it opened economies to imports. For the first time, economy could import on a large scale. Before, they imported very few things, basically raw material. If you did not have iron in your country, you imported iron. If you didn't have oil, you imported oil or coal. But over a period of time, you begin to import everything. You open your frontier to capital market, to capital changes. It's probably younger people don't realize that until the 70s or the 80s, for that matter, if you were living in India and you were an economist and you want to subscribe to the American Economic Review, it was very difficult to do it because you could not get the foreign exchange. It was foreign currency didn't move. Currency did not move. You could not change from one country to another. But with the globalization, capital market opened up and became more and more free. There were more mobility of individuals. We began to have more and more individuals that have a higher income, and they begin to move around the world, either as a tourist or eventually also as operators, in some particular activity. But mobility of individual, apart from immigrants, there was always a migration, but that was a particular type of permanent mobility. One moved from one country to another. But with there was this more temporary type of mobility. Then there was the most important thing was the growth of multinational corporation. There had always been some multinational corporation, but always in basic material type, oil company. Obviously, if you were a big oil company in the world and you went to various places where oil could be produced, but the multinational that were created starting in the 70s, they were hearing, in the late 70s, were hearings in the US Congress about this phenomenon. I think Senator Church, if I remember right, was the main senator worried about this aspect. We're a company that now begin to go to a country and begin to produce consumer goods in that country, but importing raw parts of the product from many countries. You would produce Mercedes in one country, but a part of the car was imported from other places. And this began to create problems of first of identity of a company. When a company operates in many countries, in several countries, where is the residence of that company? So the question of residency became an issue. And residency was important in the old tax system in determining tax system, was a residence-based tax system. You paid taxes on your income, didn't matter where the income came from. So the question of residency became important. Also, the problem of allocating profits. If a company produces a car by using imports from various parts of the world, how do you allocate profit? Where is the profit being produced? How do you determine that so much has been produced in the US, so much in China, so much in North Vietnam, and so this created existing difficulty that became more and more important and more felt by tax administrators. The tax administrator begin to get a really major problem in determining the residence of taxpayers, in determining where income were produced, in determining where values were produced. And this also, once this phenomenon developed, you had an accompanied phenomenon, another phenomenon which was very important, was the phenomenon of tax competition. The tax competition essentially had not really existed in the distant past. Had existed to some extent that some countries had higher import duties than other countries. But now it becomes a major phenomenon that some countries discover, they realize that they can take advantage of other countries by manipulating their tax system. So that tax competition becomes a major issue. How does the tax competition come about? Well, it comes about by trying to encourage financial capital to come to your countries. If you are Singapore, or if you are Ireland, and you can convince the foreigners to deposit their foreign capital in the financial capital in your country, and you can put a low tax on them. You encourage them by having low taxes. And once this capital is in your country, you can put a tax. You get an advantage by encouraging foreign investment. You could have low taxes on foreign investors, real investors, and you try to encourage the capital holders of some country to come to your country and produce some good to your country. You could encourage this. You can encourage some foreign consumers. If consumers can cross frontiers, and then by putting the lower tax rate on some consumer goods, cigarettes, alcohol, jewelry, etc., you can encourage people to come to your country and buy product from your country, and you get some benefits. You could encourage some foreign workers, foreign workers to locate in your countries that still produce things for other countries, and you can get some benefit from them. And you can encourage what are called high net worth individuals, very rich people, to deposit their assets in your countries. Some countries have done this on a large scale. Switzerland, Panama, and some years ago there was the Panama Papers that brought out how important this phenomenon was. According to some estimates by some leading economists, that at least $7 trillion now are invested by rich people in other countries. And of course, the rich people put this money in countries where either the tax rate are very low or there are no taxes at all, the tax haven. So all this has really, in a way, has transformed the tax system of the tax base of the world. There are tax bases of individual countries, and there is a tax base for the whole world in a kind of commons. The commons used to be common lands where everybody could go and use the land for bringing sheep or for getting wood or so forth. Eventually, in the 19th century, especially in England, started in England, there was what was called an enclosure movement, where people started putting fences around the land. And so, but the tax system of the world, the tax base of the world, to some extent, has acquired its characteristics of a common, because some country which is more clever than others can try to exploit it for their own advantage. Well, tax competition was born in this way and became more and more intense with the passing of time. Now that the country that could get, well, let me put this way: all countries try to take advantage of tax competition. For example, when the United States determined that if you were a Latin American from Argentina, Brazil, and you deposit the money in an American bank, and you said that you were non-resident alien, you did not have to pay income tax on that money. So this was one form of tax competition. But so all countries try to play this game, but it was easier for small country to play it than for very large country. If the United States lower the tax rate on very rich people or lower tax rate on corporation, it loses a lot of money. If a very small country lower that tax rate, but can get some advantage by encouraging foreigners to come to that country, the loss is much small. So the country that benefited the most from tax competition were various countries: Singapore, Ireland, Switzerland, Panama, and Hong Kong, and so forth. Well, what were the tools of tax competition? Yeah, there were different tools which were used by countries. One was low tax rate. If you put a low tax rate on corporation or low tax rate on financial income, then you attract some capital to your country. The other one, low tax burden. Generally, the lower the tax burden, the more attractive a country becomes for some taxpayer. The third one was tax secrecy. Some countries, especially Switzerland, but other countries too, they have secrecy. You can invest money in the bank, and the bank is not allowed by constitution to reveal this information to others. So through tax secrecy, some country could attract foreign money. The other one was easy administrative and compliance rule. Some countries made very easy to get money in and out, and so some of these rules were used. Another one was more predictability and certainty about future taxes. If you live in a country where taxes keep going up and down, then you don't like that, But if you go to a country where taxes are low and you have some insurance that the tax will remain low for a long period of time, then you are more likely to go to that country. Another one was tax simplicity. I've written some books in recent years on this issue. For example, mentioning that in the United States today, you have no less than, I think, 90,000 pages of rules and regulation concerning taxation, federal taxation. 90,000 pages. How many people do you know that would know what is in those 90,000 pages? I always mention that I have the strong training in public finance. I studied with Musgrave, with some of the big names, but I was head of the tax policy of the IMF, and I cannot prepare my income taxes anymore. No, and I'm not a particular rich man. I have some small property, but it became so complicated. I was wasting so much of my time trying to comply that I decided I would spend a few thousands of dollars, go to an accountant, and leave the account to make all the decisions. I just sign. I don't even check them anymore. So the tax simplicity has become very, very important. Another tool which came into to attention a few years ago in, I think, Luxembourg and in the Netherlands was a secret agreement between the tax administration and foreign investors. Sometimes, foreign investors managed to get a private, non-revealed agreement with the tax administration of a country. That assures them that their taxes will not, their income will not be taxed at a higher rate in the future. So all these have become important tools for tax competition. Of course, if a country has a very high tax rate and very high tax burden and very complex taxes, what will the citizens of that country try to do? They will try to vote with their feet, try to go somewhere else. They will send their wealth abroad. As I mentioned, there are $7 trillion of wealth invested abroad. They will go underground on some economic activity. They have activity which are not revealed to the government, and they will generally increase tax evasion and tax avoidance. That those are the normal tools. So tax competition became really a hot topic internationally. If you participate in conferences, became, as time passed, became a larger and larger topic. As I don't know whether I mentioned, in 1985, Brookings had a big project on globalization, which included the publication of various books. And I was asked to write the book on tax competition. And I wrote a book called Taxation in an Integrating World, which was published by Brookings. So this became a major issue. When I was at IMF, I participated twice a year in the meeting of the OECD in Paris. And the issue most of the time was problem of tax competition. So this became a more worrying problem, also because a problem that started having many side effects, which we don't normally think about. But one side effect was to force down marginal tax rate on some on the income which is most mobile, which is the income of the rich. And let me give you some statistics. Probably most of you know already that over the years tax rates have gone down dramatically for some groups. But let me give you some statistics. In the US, the marginal tax rate on the highest income level, personal income, during the Second World War were 94%. Then were reduced to 91% during the Eisenhower administration. Then were reduced to 70% during the Kennedy administration. Then progressively was reduced to 50%. Then they were reduced to 28%. Then the US realized that they were having fiscal problem at the end of the 80s, and the Bush father increased the rate to about 35 or so percent. By the way, he lost the election because he had promised no new taxes, but then had been forced to put these taxes. So the marginal tax rate are in the mid-30s. So this is the official rate. But then the rate on capital income would reduce much more dramatically. There were a lot of technical changes in the definition so that your adjusted gross income, before it becomes a taxable income, there are lots of things which can be subtracted, especially by rich people or by people who have high debt and so forth. So anyway, there was this progressive lowering of the tax rate on high income. By the way, the tax rate on average and normal people did not change much, And what about corporation? Well, if you go back again, the corporate income tax in many countries in the world used to be around 60%, in the 60s, 70s. And then there was lower progressively. Now in the US, they are down to 21% in the last tax reform. Imagine from 60 to 21%. So if you were a very rich guy, a millionaire or billionaire that have a high income, imagine an income that at one time would have been taxed at 94% and then became taxed at 30 at most. And if you are a company that used to pay 60%, now the tax was reduced to 21%. So there has been major tax rate changes, which in part have been brought about by some thinking about the Laffer curve and all this kind of market fundamentalism, but largely was forced by tax competition, you know. And what were the consequences of this? Well, the consequence of this that people, rich people, have become richer in relative terms. If you look at many statistics, indicate that average workers have not received real wage increases, significant real wage increases for decades. You know that the on the other hand, the people at the top 1% or 0.1% have seen enormous increase in their assets. Well, you know, this a good thing or bad thing? Well, obviously, there's a lot of controversy on this, depend on the political views of some people. People think that tax competition was very good because it forced country to lower taxes. Some people think that all taxes are always bad, and a world without taxes would be an ideal world. There are other people who take a more global or more how do you say, not non-individual view of society that think that taxes are things that we need to produce collective goods which are important, safety and security and education, health, and so forth. So depends on how you view the thing. But the bottom line is that the government now have, to some extent, have lost their degrees of freedom in the tax they could impose. You know, if a government wants now to impose a very high tax on an individual, will probably pay a high price. By the way, in the 70s, to put a little bit of humor to the talk, you know, there was a song, a Beatles song, which was called "The Tax Man." And the lyrics of the song were, "I'll tell you how it will be, one for you, 19 for me, because I'm the tax man." Because at that time, the marginal tax rate in the UK approached 95%, which was 1 to 19. You know, then of course Thatcher and Reagan came, and the situation was changed dramatically. So what has happened? What has happened is that history has changed the environment, and to some extent, economics has not adjusted to it. And the adjustment here, I comes on very sensitive ground. I'm sure that there are many people who don't share that view, and this that as I said at the beginning of my talk, you know, we are confronted with more and more global public goods, pandemics, money laundering, international crime, and et cetera, et cetera. And the generation of these public goods can no longer be left to individual country or to the action of individuals. They require collective action, and some of this require collective action not only at the national level but at the global level. So really, what a part of economics which has become more and more important in recent years, which is mechanics, the mechanics of economics, you know, that some people have got a Nobel Prize for it. The part of economics means that the mechanism of the system, of the institution that were created in the past are no longer adequate, you know. And really, we should have some institution that supervises what's going on, establish some rules, castigates countries that are abusing the rule, and so forth. So this brings me to the idea of the world tax competition. You know, this is again an idea that I first introduced in in '87 in this first book, Taxation in the First Century. then I revisited in the Brookings volume. Then I wrote a paper in 1989 that included a book of taxation, globalization, taxation globalization. I don't remember precisely the title of the book. And then I revisited it again 4 years ago in a book edited by a Yale professor, Professor Podger. And the idea was, well, why don't we create a world tax organization? An organization that would have a role somewhat similar to that of the World Trade Organization or the World Health Organization. It would be an organization that would, first of all, coordinate thinking on taxes. Now there's nobody leading the thinking on what taxes should be in the world, how they should be organized. By the way, this organization that I'm talking about would have no business in establishing tax rates. That's taxation is the most political of all activities. So the tax rate and tax level and tax burden would still be decided by national government, but would impose some rules. Would ideally have some of the top economists and tax economists in the world that would develop a thinking that would be good for a large group of countries, would provide a forum where tax changes in particular countries are discussed. Something similar happened in the World Trade Organization and in IMF. If a country wants to develop, for example, now to take advantage of other countries, well, they have to come to the IMF, present the argument. This is discussed by all the representatives of the country. The country is castigated if he's trying to abuse it, or is given permission if it is allowed, if it is justified. So something like this would be created. An institution where you can shame countries or praise countries for what they are doing. An institution which would gather lots of information from around the world. And now the information is scattered. If you want the information, you have to go to accounting firm that have their own interests. You have to go to the OECD. You have to go to the UN. You have to go to IMF. And, it would be nice to have an organization that would gather much of this information, possibly publish an annual report detailing what the countries have done, what are the main trends, what are the bad developments which are taking place, which country are abusing tax competition, and so forth. It is unlike, some people could say, well, there is already an organization like this, which is the OECD. Well, the trouble with the OECD, as I said, I attended the meeting for 20 years, twice a year. And the trouble with OECD is that it's not a world organization. It's an organization of rich countries. There are only about 30 countries which are members. And it's an organization that is worried more about the administrative aspect of taxes than about really the design of taxes. So that an organization, a world tax organization, along the line of what said, would really be an important addition to the mechanism of international institution. Maybe I will add one final thought that in the 50s, there were major thinkers. Mahatma Gandhi was one of them. Churchill was another one. Einstein was another one of them, and various other people that thought that the world really would need at some point a world government, at least for some aspects. Of course, when you talk about government, doesn't mean that would be a government that would do everything in each country, So would need a world government. But we did not have a world government. Therefore, the idea was that you could create proxy for this government, but create international institution. You create the World Bank for development, the IMF for supervising macroeconomic development, the World Trade Organization, etc. This would be a kind of ministry of a world government if the world government existed, so that I would see the a World Tax Organization as one element of this framework, of this global framework, which would allow us to deal better with the problem of global public goods. As I said at the beginning, and as I'm writing, as I've written in this new book that I hope will be published, they are global public goods for which there is no agreement whatsoever. And the global climate change or global warming is one of them. This is if you believe in some expert, this is a catastrophe waiting to happen. In the mind of some, there's no doubt that this will happen if we don't change things. But yet, there are major obstacles in bringing about the changes that we need. So that if you had a world government, it would be somewhat easier to deal with some of these global goods. But we don't have a global government, and the tax system is the same thing, the same problem. That if we go along with this tax competition, tax rate will have to come down and down and down. The income distribution will become worse and worse and worse. The esteem that we have about the market, the market is a fantastic tool for allocation, but it needs some correction. If you don't correct the market, then you have a problem. Maybe I can add a footnote. Milton Friedman, in 50 years ago, wrote a famous article about the role of corporation, saying the only business of corporation should be that of making profit for the shareholders, period. No, this is fine. I have no problem with that, provided the government does its job as correcting the market and correcting balances. But if the government does not do that job, and if the same people who want the corporation to worry just about profits and nothing else are the same one who then push the government to do nothing, then I have a problem. So on that basis, on that very controversial issue, I will stop there. And thank you very, very much.
Dr. Tanzi, thank you very much for that presentation, that lecture. That was great, great insights in your lecture, and we have a number of questions. Well, I have my own question too, but I can probably ask you some other time. I will actually give a chance to others that wrote in our Q&A tool. And I'll go in order because they're all like very good questions. So I don't want to miss out on anything here. But so one question is, I know you're talking about the World Tax Organization and of course the interaction between countries and the coordination, the cooperation in a way between countries. But there's also, the tax competition that you refer to. Is of course like a big problem also in the US between the states.
Oh yeah, I should have mentioned that, by the way. If
Right.
I can step in on that issue, in my Brookings book in '95, I have a whole chapter about tax competition among the states, and this is a big problem in Brazil where there are tax wars. In the US, there was this case in New Jersey when a billionaire, somebody who had an income of $1 billion, decide to move from New Jersey to Florida, where there are no income tax. New Jersey lost $100 million, and made a big dent on the budget. So the problem that I mentioned, I should have mentioned, I'm sorry, I forgot about it, but the same problem that exists at the global level existed also within federations. Sorry.
Right. No, that's great. Thanks for that. So the question here is, do you believe it is possible to create alliances of states, kind of like addressing the tax competition issue, like in the US?
Yeah. That's. I mean, the U.S. is always is a particular country. That maybe if you are born in the U.S., you don't realize how particular it is. If you are born abroad and you are more familiar with the arrangement in other countries, you are more aware of this conflict always between the national government and uh, and state government. Some states have always felt that the only government that counts is the state government. And some others have felt that the federal government should be really the more important one. So that the federal government should have a much larger role in determining what is allowed and what is not allowed in country. By the way, I forgot to mention that some of the solution that were mentioned globally to tax competition. One is to have a minimum taxes to force country to have a minimum taxes on something, financial incomes and things like this. They can have the maximum that they want, whatever, but the minimum, because the tax competition always comes from a lowering tax rate. Another one would be tax harmonization, which is a no starter. You could not have tax harmonization worldwide, because taxation, as I said, is the most political of all activities, and the government will not agree to that. But even within the European Union, has been very difficult to have tax harmonization. By the way, one of the reason for Brexit was there was always a fight between the European country and the UK on taxation. For example, the UK insisted on having very different rates on alcohol. But alcohol is very easy to move from one country to another, especially if there are no frontiers. So if the tax rate on alcohol are different, you go to the place where the alcohol is cheapest and you bring it. So there are problems of this kind which are very difficult to solve. I don't want to give the impression that they can easily be solved. No.
Right. Like there were kind of related questions to that. And let me just summarize. I will say there are like two or three questions that are related to having a global tax. And actually, two of them I can also see by their names are economics students or master students. So one actually coming from one of my students, Scott Cunningham, about having a global minimum tax. So, how is that plausible as a policy instrument? And another one by Derek Hamblett, another student, about the sovereignty aspect. How will the global tax, like in a system, go with the sovereignty of nations?
Yeah, well, when countries join some international organization, IMF, of the World Bank, of the World Trade Organization, and others, they agree that in some areas they are essentially giving up their sovereignty. No, and so essentially that's why the creation of a World Trade Organization is very, very difficult, because some country would not want to, especially the U.S. The U.S. would be very reluctant. Of course, depends on who is president, in the U.S. But it would be very reluctant to give up its sovereignty on this. But on the minimum tax, maybe it's more flexibility there. The assumption that all countries need a revenue for certain activities, security and so forth. And all countries have to raise revenue in some way, so that as long as income taxes are dominant taxes worldwide, then you could establish that no country should have a rate less than this, for labor income or for financial income. The more mobile the income are, of course, the higher the rate would have to be, because you want to remove the differences across countries. So I don't know whether that answered the question. You know?
Sure. Thank you. So there's a coronavirus related question, I guess, like no surprise, right? By Gregor Grebnar. So Gregor is asking about your views on the tax package that was passed by the European Commission last summer to address the corona pandemic. So what do you
Yeah,
think about?
on this I've had some views which are a little bit different from the prevalent one. I was a speaker at a big conference that the University of Montreal organized a few years ago, you know, and I was one of the three main speakers there. And they asked me to address this question. I think they're going to publish a book. It was a huge conference with 100,000 of participants. And by the way, Laffer was one of the three main speakers. Mazzucata, a professor in England, was another one. I was the third one. And my position is probably out of the mainstream, and is that crisis, especially during crisis, equity becomes very important. You know, during World War, during the major wars, countries always increased sharply the marginal tax rate on the rich, because the assumption was that especially those who can afford it should contribute more to the to alleviating the pain of the. And the pandemics is really is has this quality. You know, we have this almost obscene situation today. I'm using a strong term, obscene, that while those workers that we call essential workers, in other words, workers we cannot do without, they are suffering. They have lost jobs. They have lost have lost incomes. They have lost insurances, and the rich, they are enjoying a boom in asset prices. The stock market is at higher level ever. You know, it has gone up phenomenally in the last year. Prices of housing are up 10% or so. It's something almost unreal, no? And my view is that, first of all, really, you should have temporary, and I want to stress the word temporary, taxes on the well-to-do. The taxes that last, they are clearly connected to the crisis and clearly last during the crisis. After the crisis is over, then you go back to the normal debate on what should be the best tax system, how much you want to stimulate incentive, how much you want to redistribute income, and so forth. So, but during the crisis, I think it's really a crime to favor the very, very rich, and in a way. Also, I've had some problem with the policy, because I see this crisis as not a classic depression type of crisis where people become pessimistic about the future, they increase saving, they spend less, and the economy collapses. You know, this is not what has happened. What has happened is that for a year I've not gone to a barber, and my barber has lost income. For almost a year I've not gone to the dentist, and my dentist has lost income. And for a year I've not gone to the movies, and the people who have run the movie have lost income. And they've lost income not because of the pandemics, because, you know, the scarce. So pushing on the demand side, I'm not sure that it's really doing all that benefit. At the same time, it's pushing up dramatically public public debt. You know, and there's a big, as you probably realize, there's a big debate going on worldwide today whether this phenomenal increase in public debt. You know, Italy has gone from almost 100% to 160%. The US has had more than 20 or more percent increase in public debt. All this, whether this debt will have no impact on the future. Well, there are some economists say, well, don't worry, because the economy will grow very fast in the future. The rate of growth of the economy will be higher than the interest rate, and then everybody will be happy and no problem will come. Well, I worked in Argentina in the 70s, 80s, and in Brazil, in countries where things didn't work this way. What happened is that people got worried, they start demanding higher interest rate. The government went to the central bank and printed the money. Inflation came, and so I don't know. I may be totally wrong. I may be old-fashioned. I have a debate with one of my sons who works for Bloomberg. He tells me I'm old-fashioned. He tells me all his colleagues are not worried at all about public debt. If what they say is correct, then we have eliminated the classic economic problems. The classic economic problem was the problem that there were always too many needs and too few resources. If you can simply print money and keep pushing money to the people and without any consequences, well, that's great. But I don't know. I remain skeptical that this is the situation.
Right, great. Many more questions. So I'm finding it difficult to kind of keep up with the questions, and they're all like very good. So one question from another student, one of our PhD students, asking about the impact of the World Tax Organization on the tax havens, like how this would affect their competitive advantage. I think I know the answer that you're going to give, but yeah, I'll let you basically address this too.
Yeah, so well, very simply, the tax haven would be punished. There would be rules that made it very difficult for them to do certain things. And they would not be allowed. If you allowed tax havens, then you have done nothing about tax competition. It's as simple as that. But again, whether the the World Tax Organization would have the power to enforce those rules depends on how much power the country gives to the World Trade Organization. That's why this is an idea that has been circulating. By the way, there have been lots of paper by lawyers and so forth about this idea, but nothing has come out because I'm the first to realize how difficult it is, how difficult to convince countries that they still see the game as you gain and I lose, and vice versa. They don't see the game as one that where everybody can gain. No.
Great. A question about the role of the revenue administrations on the taxpayers' behavior, coming from Diana Mitrovic, who is working in our Nevada Governor's Office of Economic Development. She's in charge of the international business development as part of our governor's office. So how do the revenue administrations influence the behavior of the taxpayers, in terms of strengthening the compliance, regarding taxation?
Yeah, I'm not familiar with the thing in Nevada, so I have a more difficulty to address that question. Clearly, I'm I'm for transparency and I'm for equity. If if a policy does not satisfy these two conditions, is not completely transparent, and is being introduced at the cost of somebody else, then I have some difficulty. But I would not want to comment on something that I'm not familiar with. No?
Sure, sure. And one of our students, Babak Hasanzadeh, is asking about all these differences between countries in terms of their the geography, the culture, like the societies, income levels. Like how will the World Tax Organization really manage these differences, and then have them agree on a global tax code? So I know that's the big question, right?
Yeah, it's a very interesting, very important question. Again, I have to go back to the to what would be the basic role of the World Tax Organization, which is to eliminate the friction. They are clearly friction. When Fiat, for example, which was a classic Italian company, all at once finds that its headquarters now is in the Netherlands, then there's clearly a problem. When Google shows that most of its profits are in Ireland, where the profit were taxed at very low rate, then there's a clear problem. So you would have to deal with this kind of thing. And additionally, as I said, some competition will always be there, but you could reduce it by imposing minimum taxes on some kind of activity, on some kind of income. If you put minimum taxes, then you don't have the tax haven, which can have zero tax or almost zero and get huge advantage. But you cannot eliminate completely the differences. And here I come to also to an idea that I've been writing about in recent years. I think in the interview we had before this presentation the other day, I mentioned that some countries depends on the culture of the country and depends on how well the government operates. I mentioned the case of the North European countries, Denmark, Ireland, Iceland, and Sweden, etc. That are countries that have a very high level of taxation, very high internationally, but they seem to operate very well in many areas. If you look at the labor participation, Laffer and company, they tell you that if you increase the rates, everybody becomes unemployed because they are living on the government. Well, you look at the statistics for the North European countries, and they have the highest labor participation rate in the world. So you say, well, how come they can have a very high tax? So you look at the freedom, individual freedom, survey of individual freedom. They think, you always read some of the literature and say, well, if the tax rate are higher, individual freedom disappears. But then you go to Sweden and others, and you find that they have highest indices. Performance, they have been doing very, very well in many ways. So you find that if there is a combination of culture, good policy, fair, that are seen fair policy, not benefiting the lazy or those who don't want to work and so forth. No, the policy have to be right. And also make some adjustment. One adjustment that the North European countries made, which was very important, I think, was the introduction of dual income taxes. What are dual income taxes? Well, in the US, you have a unified income tax. You have an income which is doesn't matter whether it comes from labor or from capital. For capital, you have introduced particular rules to achieve some of the same purposes. But in the North European countries, essentially, they make a difference. If your income is from, say, from interest from a bank, from a dividends from a corporation, then the government takes a flat rate out of it when the payment is made to the taxpayer. And the taxpayer doesn't even have to declare this income anymore. It's subtracted at the source. And the tax on labor, then it still has progressive rate, which are much higher than the US, but not as high as the time of the Beatles song. They're in the 50s or so. So that and the systems somehow works well. As I mentioned in the interview, I was very skeptical of this system. In fact, about 20 years ago, I wrote papers against it. A paper in I don't remember why it was published. Anyway, but then I began to look more closely at the evidence, and I found out that maybe my worries were excessive. It seemed to work well, and no.
Yeah, another really interesting question. There are like many questions in the Q&A. I'm having difficulty to kind of like sort through, but Another one that I find very interesting, it kind of also gets into the climate change. So, should we be thinking about a global tax as a progressive tax or a flat tax? And regarding the climate change, should the countries that contribute more to global like environmental problems made like pay higher taxes than some others?
Well, the climate change is an interesting thing. So again, my own thinking had to develop in the last year because I did not know all that much about it. I'd worried a little bit, but then when I began to read a lot of literature, I came to some conclusion. One is that it is a real problem. One that is a problem that is getting worse and worse and worse. Some is that it has a many origin. But to give you some idea, I don't know whether you're familiar that the production of cement contributes 7% of all the carbon in there, you know. So, and if you add the steel after cement, probably you get to 15 or more percent of all the carbon in there. And well, steel and cement, of course, are very important things, and you have to produce them. So, if I don't know whether you realize that there are 1.5 billion cows in the world, and the cow produce methane gas, and the methane gas accounts again for a very large proportion of uh, of the carbon in the air. So that if you want to reduce the carbon, we have to eat less steaks, we have to have less cow, and so this is another thing. I don't know whether you realize that the increase in the temperature is defreezing the permafrost in the tundra, in Siberia. This land that had been frozen permanently and could not be used for agriculture. Now that this is no longer frozen, but this is releasing methane gas that there's nothing you can do about. This gas will go in the atmosphere, will stay there for most permanently for a long time, and well, you say, well, what about green energy? Well, green energy is fine. It's clearly reduces, and that's the key word, reduces, does not eliminate, reduces the amount of carbon that goes into the air. And the more green energy you have, the more reduction there is. But the carbon in the air is already there. And there's a lot of carbon that is already creating lots of problems, in the world. And there's a long list of these problems. Storms that we never had them before, number of storms, and the level of the sea. There are estimates that the level of the sea in New Jersey will increase by I think a meter and a half in the next 50 years. A meter and a half is a lot of increase. As the temperature increases, the sea expands, and so it raises up. As the temperature increases, the cover of ice in the Arctic disappears, and the ice reflect the sun, and so the water did not accumulate much heat in the summer. In the summer months, for 3-4 months, the sun is almost up there for 24 hours, and now there's no more ice. So all this problem now, when you combine them together, you realize that almost anything that we do will not eliminate problem, will slow down the problem. At worst, 100 years from now, at the end of this century, we'll have a world which is largely uninhabitable. No, there's a very nice book by somebody called An Uninhabitable World, with a lot of evidence. Or we'll have to adjust to lots of these problems, higher sea level, more storms, but we still survive, but survive not as well as we have been doing now. So the message that I reach in this book is really a pessimistic one, and was not the message I started with. When a year ago, when people mentioned global warming, well, I thought, it was one of those things you talk about, but that's a very pessimistic message. I'm sorry to give it, but
Yeah, no, I understand. There is a lot of talk about carbon taxation too. The US is not there yet, I guess, like in terms of passing a carbon tax, but it's been passed like in Canada, in other places in Europe, of course. So do you think that the world, a future World Trade Organization, maybe could use like a global carbon tax?
yeah, again, a carbon tax clearly would help. Would not eliminate the problem again, but would help. And if there were a world organization that pushed country to have a kind of Paris Accord, where most countries agreed to the use of carbon taxes, that would be a good thing. But I want to make two qualifications, again, which I elaborate in my book. One is that carbon taxes are extremely difficult to determine. You know, we talk a lot about carbon taxes. If you go there and you could determine exactly how much subsidies people are using coal and oil are getting, it's very difficult to determine that. And second, as I mentioned before, outside of carbon taxes, there are lots of other things which are contributing to global warming. The cows, the 1.5 billion cows, the milk that we drink that comes from cows, and also is contributing to it. There's in my book, this new book, there's an interesting discussion of income distribution. We don't realize that much of the consumption is coming from the people in the top income levels. So they are the ones who are contributing more to global warming than the average people. No, you have to take into account. So if you don't do much, you have to do something also about income distribution. The more efficient you have. At the same time, remember also that there are another 3 billion people that are supposed to be born in the next generation or so. These are people who will have higher income. They will want to have cars. They will want to have air conditioning. They will want to have appliances. They will want to be tourists around the world. And all this is contributing. So again, all these negative things have to be put against green taxes and carbon taxes and so forth. The more we do on the green taxes and green energy, and the more we do on carbon tax, the better. I don't want to get away from that message. The faster and the more we do, the better, and the more we will slow down the problem in the future. No.
Dr. Tanzi, thank you very much. We've been already going for about 30 minutes with the questions. So, of course, there are many more questions, but maybe I will make a list of those. We will save them and then, maybe address them in future lectures. We would like to thank you again very much for this wonderful lecture, and we look forward to seeing everybody in upcoming lectures. We have 2 more this semester. So thank you very much.
Thank you very much. Thank you.